So the key to this journal entry is to recognize that it's a reversal of sorts. So when we purchased inventory from our supplier, we debited inventory and credited account payable. When we make a return, we do the opposite, just reverse a portion of our purchase. So we will have 500 debit to account payable because we don't owe our suppliers much anymore. And we'll have a $500 credit to inventory because a portion of our order no longer belongs to us. Just writing a quick note here. Purchase return to supplier. Okay, so let's have a look at our second entry now. This is a little bit more twisty. So imagine the bookstore received a textbook which was slightly damaged. The bookstore can't sell the book as a new product, but is able to offer it as a used textbook at a discounted price. The supplier offers a $50 allowance for the damaged product, which will be journalized as, okay, let's talk about this scenario a little bit first. So sometimes when you get a damaged product, it's in the best interest of both parties to come to a resolution as opposed to a full return. So by accepting an allowance, the bookstore is able to sell the book to another student as a used book, and the supplier doesn't have to go through the hassle of refunding the full amount and getting the item back. So in some ways you can look at this as a win-win for both sides. So how does the journal entry look like? Well, we're going to have the same date here, May 21st, and we're going to have exactly the same things happening. The debit will be to accounts payable because we now owe $50 less to our supplier, and our credit will be to inventory because the book isn't as valuable as we initially thought or assumed. So I'm going to go ahead and write a brief description, 4 simple words to explain what's happening here. Received a purchase discount. So there, all done. These 2 journal entries. As with a purchase discount, the inventory value is credited or lowered to reflect the allowance. Account payable is debited or reduced to reflect the lesser amount now owed to the supplier. Moving on to a new topic again, transportation costs. Free on board, or FOB, are terms in the purchase agreement which specify who pays the shipping charges. However, that is not all. They also specify when the legal title or ownership passes from the seller to the buyer. FOB shipping point mean that the legal title passes when the inventory leaves the seller's place of business, which is called the shipping point. The buyer owns the goods while they're in transit, so the buyer pays the freight. FOB destination mean that the legal title passes when the inventory arrives at the destination, so the seller pays the freight. So freight in is the transportation cost on purchased goods, which is normally paid by the buyer. So let's assume that the SFU bookstore hires a delivery company to ship orders from a supplier to the college. So think about what the journal entry might be when you pay the delivery company, and we'll go over this in 1 minute here in this same video. So when you're shipping in something which will be sold, you're adding value to that good. You're bringing it to the point where it can be sold to your customer. So it's not an expense yet, it's part of inventory, because the idea is that you will be selling this good and making revenue off it. So we throw it into inventory, and when it gets sold, it becomes part of cost of goods sold. As discussed earlier, shipping costs are included in inventory since they're a part of a business's cost in bringing goods to the selling point. It is also common for a supplier to include a shipping fee on the purchase invoice. In this scenario, the buyer would have just one journal entry to record the inventory purchase with the freight already added in. So the idea here is, if you were to buy $3,000 worth of goods and the invoice had a $30 charge for shipping added in, you would just make one journal entry for $3,030 as opposed to two entries, one for 3,000 and another one for 30, because the entire amount belonged to inventory anyway. We're going to finish this off with a quick description. Purchased inventory on account, including freight. Freight out is the transportation cost on goods sold, which is normally paid by the seller. Freight out is generalized differently, since the goods being transported are no longer a part of the seller's inventory. Therefore, the freight is simply an added expense for the business. Let's make a journal entry for the SFU bookstore, shipping an order of textbook to a student in Shanghai. So we're going to go ahead and make up a date here, May 31st. And the big difference here is that this time the transportation costs do not get added to inventory, because the product has already been sold. The sale has already happened, so we are no longer bringing the product to the selling point where the customer can buy it. Instead, we've already sold it, and now we pay the delivery expense with cash to get the books to our customer in Shanghai. Once again, write down a brief description, paid freight costs for order shipment. Now we will have 4 journal entries for review. We have the first transaction, which is a sale on account. The first box here will be used to record sales revenue. The second box will be used to record reduction in inventory. And then the second transaction will be for cash sale. Again, the first box for sales revenue, the second box for reduction of inventory. So take a minute to try these 4 entries, and we will go over them in the next video.